Hello and welcome to Overcoming New Car Headwinds in 2019. This automotive news power training webinar is brought to you by vAuto. We're delighted you're with us today for this presentation. My name is Philip Nussel. I'm the online editor at Automotive News. Before I introduce our speakers today, I wanted to give you all a few navigation tips. First, we encourage you to ask questions at any time. You just type them into the Q&A box on the left side of the webinar window, and then you hit submit. I will steer your questions to our speaker towards the end of the session. Also, to enlarge the slides, you just grab the frame with your mouse and pull it larger. To download the slides, click on the handouts icon at the bottom of your console. Today's speaker is Brian Finkelmeyer. Brian serves as the Senior Director of Conquest at vAuto, where he is responsible for all aspects of vAuto's new car business. And with that, I'm going to turn it over to Brian now to get us started. Brian, have at it.
Great. Thanks, Phil, and good afternoon, everybody. I spend a lot of time reading and talking with dealers across the country about many of the headwinds facing our industry, and I think we can all agree that the market has really become a lot more difficult here in the last couple of years. And I think one of the questions becomes is, what are we doing proactively to improve our operations? About 7 years ago, Best Buy was actually on the verge of becoming another victim of Amazon and internet retail. And they took it upon themselves to take a number of proactive measures to reinvent themselves, and have become a real success story. In fact, I looked today, their stock had gone from $20 to $82 this past August. So they've had just really incredible success by refocusing their efforts on really employee engagement, pricing transparency, more efficient operations in the back end. And so many of those things I think we need to think about, and how, what I've spent some time putting together for you here today is a few ideas and some success stories that I've picked up from dealers across the country of how I think we can be more proactive in our business in building out more efficient operations and giving us a strong fighting chance to overcome some of the challenging new car headwinds that we're going to face in 2019. So with that, I'd like to just kind of touch on some of the, the headwinds that we definitely see coming. The first of which I want to just call out is just this growing affordability concern, specifically on new cars. You can see back on 2013, the average monthly payment for a new car was about $464. You fast forward to the latter half of 2018, and you can see that's up, $75 or so. So it's certainly become a lot more expensive as customers have increasingly moved towards trucks and SUVs, and obviously the rising interest rates have also had a material impact on customers' monthly payments. I think one of the other things that we need to keep an eye on is one of our chief economists at Cox Automotive says that, to understand the new car business, you need to understand the used car business. And what our forecast is for this year is that we're going to see an all-time high number of off-lease vehicles returning to market. And so when we think back to that previous slide about the affordability situation and, how it's $550 roughly per month now in a new car monthly payment, I think obviously these cars that are 3 years old are going to provide a very compelling value proposition to consumers, and I think that's certainly going to put some pressure on overall new car volumes. And then, as I mentioned earlier, just this rise in interest rate environment, not only is it having an impact on our consumers and shoppers, but certainly having an impact on our business as well. The HEG report earlier this year had done, I should say last year, did an analysis of public companies, which estimated that a 1 percentage point increase in interest rates equated to about a $250,000 impact on the bottom line. And so, I've got a picture here of our Fed Chairman, Jerome Powell, who has already stated that for 2019 we expect a couple more rate hikes. So this environment of more expensive money is likely to get worse, not better, here in 2019. And then one of the last things I want to kind of touch on, just to, from a macro perspective, is the new car volume. And if you look back there at 2015 was sort of the high watermark at 14.4 million. And I guess I should point out that, the industry really tracks the overall SAR, which includes fleet and rental and government sales. But I like to just look at what's going on from a pure retail perspective of what's being sold through the dealership network across this country. And you can see that we're at a pretty steady downward trend over the last few years. And one thing that was particularly interesting to me, I felt worthwhile of calling out, was that, last year the industry did finish out at 17.3 million total new cars, including fleet and retail, which I believe I read was the fourth best year on record. So despite a lot of negative publicity in the market, the overall volume was actually halfway decent. But what's interesting in that number is there is some noise in there from Tesla, which is that Tesla actually was able to deliver 100,000 more cars than what was originally forecast. They delivered just shy of 250,000 cars. And really Tesla was living off of some pent-up demand of the hundreds of thousands of people that had put deposits down on the Model 3. And so to be curious to see, whether or not they can sustain those types of volumes as we move into the future. I think most analysts would suggest that, that uptick that we saw from Tesla is not going to prop up the industry like it did last year. And then, we at Cox Automotive do a quarterly dealer sentiment survey that many of you may participate in. And just one of the simple questions that we ask is, how would you describe the current market for vehicles in the areas where you operate? And you can see a pretty noticeable decline in sort of the overall level of optimism, just going from Q3 to Q4 in 2018 as we dropped almost 10 points, as I think more and more dealers are realizing that this market is certainly becoming quite a bit more challenging, really on the new car side of things. So all of these headwinds from a macroeconomic perspective, I think we need to digest and then look at our operations and think about ways in which we can be proactive and ways in which we can make our businesses more efficient for helping us overcome these challenges that lie in front of us. And so today I really want to talk about, what I believe to be three key areas of opportunity for most dealers. And the first of which I'm going to delve into is just this new vehicle inventory management piece of our business, which largely has been overlooked by many dealers. I think we, as an industry, do a great job of looking at our used car business with a very granular lens, but the new car inventory is oftentimes overlooked. And when you think about the large amount of capital that is tied up in our new vehicle inventories, certainly strikes me as that's a big opportunity where we can become a lot more effective in managing that piece of our business. And then the second thing I want to talk about is what we call accelerating the wheel of fortune, which is really the new car, as you all know, is really, I think of it as the ignition switch that sets off a chain reaction of higher revenue and margin opportunities with our F&I and the ability to collect trade-in vehicles and whatnot that really provide sort of the financial lifeblood of our dealership. And so I want to talk about some ways I think in which we can restructure our organization and ways in which I think we can be more effective, specifically in the area of appraising trade-in vehicles to accelerate that wheel of fortune and drive more profitability through your operations. And then lastly, they think that this year somewhere in the neighborhood of 65 to 70% of all dollars being spent in marketing for automotive is going to be shifting towards digital. And so it has really become no longer a nice to have, but I would argue a need to have in terms of becoming really an expert in the area of digital marketing so that you can compete with those players that are out there that are already sort of out on the cutting edge of the digital marketing space. So let's first dive into the inventory piece of this presentation. And Warren Buffett, one of my favorite lines from Warren is he says that when the tide rolls out, we can see who is not wearing a bathing suit. And I think in many respects, the tide is beginning to roll out in the new car business, and it's going to become incumbent upon us to begin paying more attention to things like our new car inventories And the days of getting away with sort of speculation and making decisions with gut feel, I think those mistakes that we do make from time to time are going to become quite a bit more costly as the new car market contracts and the cost of holding inventory continues to rise. And so we need to begin adopting more of an investor mindset. And, when I looked at Berkshire Hathaway and their top 10 holdings from last year, you can see that, Warren Buffett, he's got a mix of winners and losers on the year. On some stock holdings he's done very well with, and on others he's not doing nearly as well with. And I guess the point that I want to make here is that, I certainly would think that the folks at Berkshire Hathaway have a very clear understanding of the winners and losers within their portfolio. But when we look at the average, in this example, Ford dealership, and we think about each of the unique pieces of inventory that is on our lot, do we have that clarity around which of these vehicles are winners and losers, and which of these investments we should feel good about, and which of these investments we should feel some degree of concern about? And I think largely is the case, we don't think that way. I think we look at things at 30,000 feet. We tend to understand, hey, I've got $8 million on my floor plan. I'm stocking about 300 cars. We tend to know these kind of big picture things, but we tend not to understand things at a more granular level. And I just think in this era of, extraordinarily compressed margins, and we're feeling pressure on all sides of our business from an expense side of the equation, it really is important that we begin to look with a more granular lens at things like our new car inventory. And so, one thing that we can do, with technology is to begin diving in with a much more granular lens, as I said, and understanding that this 2018 Ford Explorer Sport and Magnetic has a market day supply of 48 versus the overall average for Ford Explorers is just 72. So in that particular case, this particular asset is turning about 24 days faster than the average for that model, and the competitive set size is only 10, so there's not a lot of competition in the marketplace on that particular combination. But then if we look just a few cars down the list, we can see a car that we should be really concerned about, this Ford Escape Select in ruby red, 240 days worse than the average for Ford Escapes, this particular ruby red combination. And there's 76 of those in this dealer's particular market area. So there's a heck of a lot of those sitting around, and they're not moving very quickly. And so I think we need to begin taking this information into account when we're making both pricing decisions as well as our promotion decisions, so that we're perhaps even using cars like this as loss leaders or taking action on these versus just continuing to let these vehicles age on our lots and age on our floor plan financial statements. And so within that, we've started doing what I call a LIFO-FIFO analysis at vAuto. And what I like to do is look at a dealer's inventory, and in this particular case, we've got the green, yellow, and red. So the green graph there is this particular dealer has about $3.6 million worth of fresh inventory that has been there 0 to 60 days. Then you could see he's got about $1.9 million tied up in kind of that 60 to 120. And then what I deem to be aged inventory is really anything north of 120 days, because most OEMs are providing dealers with roughly 4 months of floor plan assistance. So one way to think about it is, I would say that one of the key differences between a new car and a used car is that a new car comes with an insurance policy, but that insurance policy only lasts for 4 months. And so when we look at this particular example, this dealer's really got about $7.8 million tied up of quote-unquote uninsured inventory, where that chunk of money is really what's driving his holding expense. And what I see about 85% of the time is that dealers unknowingly tend to execute a LIFO approach, which is to say they tend to sell the last in, tends to be the first out. And that's exactly what happened in this example. You can see that this dealer actually sold $3.8 million worth of fresh inventory in the prior month, and he finished the month with 3.6 left in that fresh inventory bucket. And then when we look to see how good of a job that he did of getting rid of that frozen capital, you can see that he sold quite a bit less, 1.1 million. So I just think that this is a real simple analysis that dealers should be looking at, to understand what is my exit strategy on that $7.8 million that is really driving my holding cost expense. And so this is something, as I said, we've been paying a lot more attention to and trying to help dealers better identify ways and strategies for staying focused on that. You know, as I've mentioned, I guess, a few times just sort of in this conversation so far is that this cost of inefficient new car inventory management is really becoming quite a bit higher, and that, you know, back in 2015 when times were good, interest rates were low, new vehicle volumes were very healthy, the average dealer based on NADA had pocketed about $110,000 in floor plan profit. Non-commissionable gross is the favorite gross for car dealers. Well, you look to fast forward today, and the average dealer in 2018 stroke a check for about $60,000 in holding costs. So just in a 2-3 year period, we're talking about $170,000 swing in our profitability. And just to kind of put some math around that, you know, at 2% net to sales, we would need to generate about another $8.5 million in sales, which is roughly 300 additional car sales to fill that bucket of $170,000, that has been taken away. So I think this is a much bigger issue than what a lot of people realize, and why it's really important that we begin spending more time focused on that particular area of our business. You know, I just want to close this section with an example of a dealer that has done a fantastic job of focusing on this aspect of her business. This is a store up in the Philadelphia market. And you can see here that they're stocking, roughly 300 plus cars. And it's just remarkable to see that they've got 5% of their inventory is older than 120 days. I mean, that is a fantastic looking, allocation of their assets. And I think there's a couple lessons to be learned from what Team Toyota does up there, is one of which is they spend a lot of time focused on which vehicles they're bringing into inventory. They also do an expert job of using price as an effective lever to blow out aged inventory. And so they are constantly focused on this. On their Monday morning meeting, they're talking about those 10 oldest cars in stock and what's their strategy for getting rid of those cars. And I think it's that kind of daily and weekly focus on this particular issue. Every dealer on this call could have a distribution that will look just like this. But the reality is, I'd say probably 95% of the dealers' aging spread that I look at looks nothing like this. It actually would say looks more like the opposite of this scenario than this particular case. So I just use this as an example to show, what one of our very successful dealers is doing. And I would venture to guess that the floor plan profitability situation at this particular store has not been impacted nearly as much as the average dealer. So now I want to move into the next section and talk a little bit about the Wheel of Fortune. And just for everyone's understanding, as I mentioned, the new car sale, albeit I think NADA reported the average front-end gross this year was around negative $600. But, there is some benefit that comes with having a loss leader like a new car sale, which is we get an opportunity to obtain a customer's trade without having to go to auction. That's a good thing. F&I margins continue to improve in terms of the PVR that dealers are collecting has gone up, and obviously F&I provides very high margin opportunity. And then largely, I saw an analysis earlier this year that said that 90% of the money that dealers book in their net adds and deducts category in their financial statement was coming in the form of OEM factory bonus money. So certainly selling more new cars faster is going to give us a much better chance of cashing the check from the factory. And then last but not least, obviously we want to build our units in operation for future, parts and service opportunities. And so the first thing I want to talk about is, what I believe to be perhaps one of the biggest opportunities for dealers as we think about 2019, which is to become much more effective at our trade and appraisal process. And so I want to start with just an example of a friend of mine literally sent me this text a few weeks ago. And there's a Nissan dealership not far from where we live. He had taken his vehicle there for an appraisal. They offered $22,700. He literally drives basically across the street to the local CarMax operation, which offers him, almost $2,000 more money for the exact same car. And those two appraisals happened about 15 minutes apart. And so what was interesting to me after, getting that text was that Black Book had done an analysis which said that about 63% of customers believe that their trade appraisal is missed by $1,000 or more. In fact, 27%, just like my friend, believe that, that particular dealer missed his trade by $1,500 or more. And I would say that, it was the case with my friend and is the case with many people that have experienced that. I would say that that is a new car sale that could have happened, that didn't happen. We didn't even get to test drive the car because we had missed the trade by such a large degree. So one thing you may have heard or seen us talking about recently at vAuto is we are launching a product called Profit Time, which really looks at a dealer's used car inventory, and instead of grading cars out based on how long they've been in stock, we are now grading each car based on their relative merits, looking at their average cost to market, which is my acquisition expense relative to the expected retail, and then the market day supply. And so when we look at this analysis, 99% of the time, dealers look very similar to this example that I shared, that a fairly low percentage of their cars score out as platinum, which are cars with attractive cost to market, low market day supply, and a fairly high percent, 45 to 50% typically, score out as bronze cars, which are high cost to market, high market day supply. Well, if you really stop and think about it, as we as an industry, if we begin to adopt this way of thinking, our job is to figure out how I build my used car inventory with more attractive merchandise that's going to sell quickly, that I can make more gross on. And the best way to get more platinum and gold cars is to not spend more time at auctions, but to do a better job of capturing customers' trades. And in fact, in an analysis that I had done last year, what I saw was that the gap between cost to market on an auction car and a trade car was about 11 points of margin. So the average auction car was coming in at around 89 to 90% of expected retail, while trades are coming in closer to 79%. So I think when we're scraping for every dollar we can make, this trade-in piece cannot be overlooked, and it's important that every dealer is paying close attention to what their look-to-book ratio is, so we understand how many trade appraisals a month are we missing, because the alternative is I'm going to auction paying top dollar. What's really interesting to me, and a colleague of mine just shared this with me just recently, is that if we look at many dealers have a very similar scenario to this. This is just a Toyota dealer that we pulled more or less at random. And what I looked at here was, you can see this cost column shows what the acquisition expense, including recon, is on every single used car in their inventory. So I just took a snapshot, cars that were between 11 and 15 days old, so relatively fresh inventory. And then I compared that to what's the current KBB trade value at excellent. And what was just alarming to me is to see the degree to which these cars are being owned at above the KBB excellent range. And so as we delve into that deeper, what it says is that only 3% of KBB, 3% of cars actually score out as excellent. I believe it's 23% are very good and 54% are good. So, one thing to think about is, in this particular case, this dealer would have been much better off had they just printed out a sheet like this that provided the KBB reference and handed the dealer, the customer, the check for KBB excellent. If I go back to that prior slide, they would be anywhere from $2,000 to $3,000 better off had they just stroked a check for KBB excellent versus, whatever process they use. So many of these cars may have been purchased at auction. Many of these cars maybe had too much recon put in. There's something obviously wrong here, and I think this is something dealers should be paying closer attention to. And so what was interesting to me is that I don't know how many of you had a chance to look at Carvana's site, but one thing that Carvana is doing in their quest to provide a very frictionless sales experience is they are leading with the KBB value. And they actually, I did this assessment on one of my cars this weekend, and you can see here that, they gave me a plus minus versus what options I had. I pick up $1,000 basically because I'm slightly below the market average for mileage. and then provide a very clear trade-in appraisal process. And I think, we need to make sure that we're doing things like this on our website, because so much of the traffic that is visiting your dealerships is obviously not physically visiting, but they're visiting your online showroom, and ensuring that we're taking a page out of Carvana's playbook, whether you use KBB or any other third-party reference. That I think this is a great way to certainly build trust and lose a heck of a lot less trades. The next thing I want to talk a little bit about is just, rethinking our comp plans and our organizational structure within the car dealership. And, I talked to a dealer recently who told me that his 2 F&I managers last month made more money than the entire sales department combined. And often is the case, I hear stories of F&I managers making 18 grand a month and desk managers making 8 to 10 grand a month. And if we think about, who's driving that wheel of fortune, it's the new car desk managers that are, keeping track and achieving the factory bonuses. They're the ones that are hopefully creating more trades and recon, the F&I income. All of those things is really being generated from the sales tower. Yet often is the case, it seems that the F&I department tends to reap all the rewards. And I don't know if that's such a case because they're expert salespeople, or, some of that's just because they are lucky enough to sell a much higher margin product than selling new cars. And so, there's a group up in Minneapolis, the Walzer Automotive Group, very progressive organization. And one of the challenges that they had a few years ago was just the prevailing challenge across the industry, which is they had trouble attracting and retaining good quality people. I think this has been, as long as I've been in the car business, this is a consistent, is finding and keeping good people, and I imagine that problem has not gotten any easier. And so what Walzer did was that they took all of that money that had been allocated to their F&I department, and they basically took a page out of CarMax's playbook, and they turned their salespeople into F&I managers so that their customers had more of a one-stop shop experience. And I would say that, perhaps the single biggest frustration of today's customers waiting to get into F&I. In fact, I last year went and purchased a car for my wife, and everything was ready to go, but I had to wait about an hour and a half in the showroom before I could meet with the F&I manager. And so this is the friction that our current organizational structure is creating. And I think customers are obviously desperate for speed and efficiency. And so Walzer is addressing that. And the great part of the story was that they actually improved their PVRs by about $300. So, one of the lessons that I've learned over the last couple of years is that dealers that do a good job of removing friction actually make more money. And so, I think this is something that many dealers need to take a closer look at as we build out our operations. And kind of going back to that example of Best Buy that I used at the beginning, how do we proactively transform in our business to better align with what today's customer wants? And I think ultimately provide better outcomes for our businesses. So the last thing I want to touch on today is the digital marketing piece. And, Facebook and Google are going to collectively generate about 65–70% of all digital ad dollars will be spent on these 2 platforms in 2019. And so I would say, just as a foundational element to any dealer's marketing mix, that if you don't have a sophisticated strategy built out on Facebook and Google, you're really missing the boat, because this is largely where today's customers are. And in fact, as a friend of mine that works at Facebook says, it's really no more complicated than simply fishing where the fish are. And so, this is interesting. If you look, the average dealer last year in America spent about $585,000 in advertising, close to $50,000 a month. And this is an average of average, but this pie chart depicts all of the different places that dealers are placing bets when it comes to advertising: local television, radio, direct mail, telemarketing, email, et cetera, et cetera. And so to me, it seems like we need to adopt more of a do less and obsess approach to our marketing. And I think that really starts on Facebook and Google. And so first, let's talk about Google. They're going to generate about 42% of all digital ad dollars will be spent on Google here in 2019. And Google is really, I would say a demand capture opportunity for dealers. And many of you already know this, and I'm sure many of you have seen this, that Google has sort of highlighted what they call 5 key micro moments to winning the sale. And I've highlighted there in green the micro moments that the dealers really need to focus on, which is the can I afford it, where should I buy it, and am I getting a good deal? And so it's really critically important that you're buying those important intention keywords, such as 3 Series lease deal or X3 lease special or Nashville BMW dealer. Those types of key intention searches are the ones that dealers need to be picking up on, because as one person told me, customers are going to Google with a question, and really the question for dealers is, will you be there to answer that question? And so I know that many dealers are spending a lot of money with Google, but it's in many respects an absolute necessity. And then one of the really neat things that we're doing in conjunction with Google is, and I touched on this earlier in my FIFO-LIFO slide of looking at that $7.8 million worth of aged inventory, is one really neat tactic that dealers are beginning to deploy is using certain cars from that 7.8 million as loss leaders, just like we would have done 20 years ago in the newspaper. And then we're able to integrate and use that to drive paid search ads right on Google. And in this case here, we're highlighting a Kia Sorento starting at 22,609. And this link here will take you directly back to that listing page for that dealer. So this has been we've found a very effective tactic towards helping dealers more effectively manage that aged inventory, and it doesn't necessarily just need to always be a price reduction. Some of this is we have to promote that we've made a price reduction. And so now moving on to Facebook, as I mentioned, Google's really demand capture, and I would say that Facebook really lends itself more to demand generation. And there's really 3 simple building blocks towards building out, an effective Facebook strategy. And the first of which is just using Facebook to retarget your website traffic. And I'm sure your advertising partners can very quickly help you get set up and running on that if you're not already doing that. And then I would say the second layer down is to use your CRM data to have Facebook go out and identify lookalike audiences or customers that look very much like the people that you've currently sold to. Facebook has become increasingly effective at being able to go out and attract and grow greater audiences for you of potential customers. And then lastly, you can work with companies to actually even buy third-party audience data of current shoppers that are in market to market to. And so much of it, I think I read that close to 70% of Facebook's revenue is coming through mobile. And I'm sure that's no surprise to any of you that the mobile has become so critically important. And so I just wanted to highlight just a couple great examples of what some dealers are doing out on Facebook. The first of which is, Paragon Honda out in Queens, New York, really uses Facebook to create awareness for their service department. And I would say that, I would call it the service department Trojan horse, that often they are attracting customers to their dealership with service. And once the customer gets there, they've got a very smooth trade appraisal process, and they're flipping customers into new cars. But much of that starts with Facebook and being able to capture customers from oftentimes outside their local market area. And then the next example is a Lexus store in Santa Monica who is effectively using Facebook to identify very targeted demographics. So in this particular case, an LS500, is a $90,000 to $100,000 car. We obviously want to be very targeted in who we are serving that ad up to. And that's just another great example of how Facebook is able to help us with pinpoint precision identify the right people to put that inventory in front of. And then the last idea I want to share that I thought was pretty cool is a dealer is using Facebook Marketplace and actually linking this to Messenger, so that if a customer clicks on any one of those 6 used cars that's in their scroll, it automatically syncs them up to Facebook Messenger, and they're essentially initiating a live chat right on the mobile device. So these are just three simple examples of how some more sophisticated dealers are using Facebook ads. And I guess I would mention that one of the things that's best about this is on a relative basis, Facebook is very, very affordable and a cost-efficient way to create some demand generation and lead activity for your store. So to kind of wrap things up, just to kind of highlight some of the key points that I made, I think going back to this necessity of beginning to think more like an investor than a speculator on our new car inventory. And often I'll ask dealers a very simple question, which is to say, I see that you have $10 million invested in capital tied up in your new car inventory. How happy are you with the performance of that inventory, of that investment? And often is the case, dealers don't have a real straight answer for that. And the reason why is because I don't believe that they're paying close enough attention to it. The second piece that I touched on there was just the opportunity on the trade appraisal process. And it is peculiar. I'd ask all you to go back and look at your acquisition expense of your used car inventory relative to what you would have paid had you just handed the guy the check for KBB Excellent. And perhaps some of you are in a similar situation to that Toyota dealer that I pointed out. And then, we talked a little bit about the need to think, at least consider reorganizing our dealership operation and our compensation plans to accelerate that wheel of fortune. And then lastly, I hopefully shared at least a couple ideas of how dealers are using both Google and Facebook. And I think one of the big focuses for 2019 is, I don't believe there's any daylight on the margin side of the business. So we need to become much more efficient on the ad spend side. And I believe last year NADA reported about $627 per car in ad spend. I think we as retailers have to figure out a way to draw that down. So with that, I'll open it up to questions, but I guess I'll first just end with one last plug for any of you that are going to be at NADA next year. I'll be at our vAuto booth for most of the show, and I would certainly welcome anybody that would like to drop by and talk a little bit about your new car operation. So with that, Phil, I'll open it up to questions.
Okay, we've got a couple good questions here right off the bat. There's a Nissan dealer here. He's in a major market, and he's wondering, this is a kind of a classic factory to dealer problem, but he's wondering how you would advise dealers on the pressure and programs manufacturers come up with to buy cars from them when they have overproduced. This is a problem as old as the auto industry. As a Nissan dealer, this has happened 2 years in a row for me. They are paying us significant amounts per car to buy from them. The easy answer is to just say no to them, but when there are 30 other dealers in your market and you are the only one who says no, then you are at a serious price disadvantage. What do you tell this gentleman?
Yeah, I mean, that's certainly not an enviable position to be in. I guess a couple of thoughts go through my mind. The first of which is that the public companies tend not to play those games very much. I think oftentimes that inventory pressure gets put on the single point dealer, while the big operators tend not to play that game from my experience. So that's one thought that goes through my mind. The second thought that I have, though, is that if you are taking inventory, oftentimes we our factory rep calls us with a list of 200 cars, and we kind of say, I'll take 5 of those, 5 of those, 5 of those. I think going back to my slide earlier with the Ford example, I had a Ford Escape Sport, I believe, that had like a 42 market day supply, and then I think we showed a Ford Explorer Select that had about a 300 market day supply. And if you guys recall, there was a difference between 10 of one combination and 76 of the other. I think it would be smart for dealers to use a little more granular information so that when I'm saying yes to the factory rep, I'm using more precision in my analysis than just sort of, back a napkin doing somebody a favor off a gut feel. So if we are doing favors to the factory, I'm not telling anyone not to do that, but I would say perhaps we need to spend a little more time doing homework before we make that decision on which units we're taking.
All right. Here's kind of an F&I question with the rising of federal, with the rising interest rates, in the market volatility, trade wars. Do you think there's a risk that the financiers, the dealers need to keep an eye on the risk of missed payments or reduced credit ratings? How do you combat the risk of potential customers not being able to pay?
Yeah, I mean, I think that's really more of a headache for the captive finance arm than the individual car dealer, I would say. Generally speaking, repossessions and delinquencies tend to hit the finance arm's books with much more pain than the individual car dealer. But I think, your point, though, is this secondary finance, what's going on there. My sense is that banks are beginning to tighten up a little bit on that business. One stat that I heard that was interesting recently was that Americans' credit card debt load now has gone back up to sort of the level that it was at prior to the recession. So Americans are increasingly strapped, from a credit card perspective, and then as rising interest rates, are pushing up people's monthly payments on their credit card. It's obviously, I think many American households are beginning to feel pressure on those points, and meanwhile, effectively wages have not, increased at the same degree.
Here's a media strategy question. I'm not quite sure I'm reading into it correctly, but how should dealers be thinking about getting the message out about their services between local TV, social media, and the dealer's website itself? Is there any new strategies there for 2019 that our audience should be thinking about?
Yeah, I think one of the growing trends that I've read that Google is really pushing, and I didn't touch on it in the presentation, but video on the internet is I think like the fastest growing piece of the advertising pie, and so Google is making a real push on YouTube advertising. And so with that, you can become quite a bit more targeted than just running a cable ad in your local market area. So I think that, that would be one area that if I was a digital marketing director, I would be looking at for 2019 is how do I build out my YouTube advertising, which in many respects performs similarly to network or cable television. But I think from a cost perspective, it's quite a bit less expensive. So that would be something that I would probably look at if I was, looking to sort of, still figure out how I keep some presence and awareness for my brand, for my service department, but looking for ways to do that in a more cost-effective approach.
Talk a little bit more about the affordability issue that you touched on a few times during your presentation. Especially when it comes to younger buyers who are debating whether I need to buy a car or do I want to do car sharing? Do I want to use Uber for all my transportation needs? I've got a bunch of student loan debt here. That really puts the pressure on the dealers to really try to maximize value for the younger customers in particular who got to watch every penny. What sort of strategy? And that's just going to become more of an issue again with the rising interest rates and the other headwinds that we're facing this year. What do you advise? Any special strategies of the dealers should be thinking about for the younger buyers who may or may not even want to have a car of their own?
Yeah, it's a great question. And, I was with some colleagues a couple weeks ago, and I don't know how we got onto this, but the discussion was, what do you see to be the biggest prevailing threats to the retail car business? And, there was talk about, autonomous cars and ride-sharing services and all that. And none of us know. This is just my own 2 cents. But what I would say is the single most alarming macro trend to the retail car business to me that's concerning is from 2008 to 2018, the percentage of people that are 18 and older with a driver's license has dropped like 15, 20%. So it's gone from like 93% to, in the high 70s, low 80s. So that kind of speaks to this issue of less and less of these millennials are interested in a driver's license. And I think sort of one of the points you're making there about, the high rising cost of vehicles and the affordability, many of these millennials are sort of participating in what they refer to as this gig economy. And certainly people from my generation that went off and found a 9-to-5 job, that seems to be less appealing to today's young people entering the market. And when you think about it from a pure economic standpoint, they say that our cars basically sit parked about 94% of the time. And so, if I am feeling financial pressure, as you say, on student loans and some of these other challenges, I'm perhaps not making a big salary, I'm covering health insurance on my own, et cetera, it would strike me that a new car or even a used car has become, in the past, I think we all thought of that as just a necessary thing, as a need to have, and now there's so many other ways that people can get transportation. I do see that as a challenge for our industry moving forward.
I noticed on your slide that dealers have a higher cost in their used cars than KBB Fair Market Excellent. How does that happen?
Yes, I think it's a combination of things. I think one of which is that in that particular case, I didn't go back car by car and look, but I suspect that a number of those cars were probably acquired at auction. And as one dealer once told me a long time ago, the reason why he hates going to auction was because that means you're willing to pay more than anybody else that's there. And so part of that may be over-reliance upon the auction. And then I think the other piece that, need to be a deeper investigation on those cars that I showed was just, what was the reconditioning expense? Do we have a situation there with a parts and service department that's kind of got a runaway checkbook and maybe over-dialing on the recon? But I think, looking at that group of cars that, we just picked the dealer at random. It wasn't a lot of, it was the first store I looked at. Most of those cars were $2,500 to $4,000 over KBB, which tells me that dealer probably does not have a lot of breathing room from a front-end gross margin perspective once he goes to retail those. So I think it was an interesting analysis that certainly those of you that are on vAuto should take a closer look at that within your tool, because that information is readily available.
Brian, talk a little bit more about digital retailing in 2019 and what kind of trends that you're going to see going forward. In particular, on the you talk about the F&I payroll being very expensive to employ F&I managers. Are there more resources for dealers to try to mitigate the cost of F&I by going online, or is that not advisable? If I there's a lot of tools out there that are being developed in the used car business that make a lot of these transactions completely online. Is that something dealers should be worried about, or should they be asking the factory for more help with that, or asking their dealership group parent companies? Where do I get help on F&I resources like that and digital retailing in general?
Yeah, so what I think is really interesting on the digital retailing is that a couple dealers that I know well that have begun adopting these solutions, and there's a couple of them out there, one of which is growing pretty rapidly, is called Roadster. And then I know, Dealer.com also offers this. Auto Trader is now providing a solution called Accelerate. So there's a lot of different, iterations of this popping up. But what's interesting to me is that I've heard almost universally from all three of those parties that the F&I gross is actually higher when we get people out of the way. And I think I sort of touched on that earlier, this whole notion of removing friction and making more money. What we have found to be the case in some of the early examples that we've seen even at Auto Trader on the Accelerate program is that dealers are making higher F&I dollars by not having people involved. By providing a menu of options and staying out of the way, their PVRs are going up. And it's interesting to me, CarMax is obviously a pretty successful business. They sold 1 million used cars last year, and they use a menu on a tablet within the dealership showroom, and it's a very much kind of serve yourself. I don't know off the top of my head what CarMax PVR is, But, more and more we're seeing dealers and operators like Carvana that are going that direction of kind of putting the customer in control, removing friction, and making more money. And so I think that's really a key thing we need to think about for 2019.
Wow. I mean, it's almost like we don't even, at some point there won't be a need for an F&I department? Is that ultimately what we're talking about?
Well, I don't necessarily would say that. I mean, we're still going to need to have people that work with the banks and get all the stipulations, and there's a certain amount of dotting I's and crossing T's of finance that I don't anticipate that that's going away necessarily. But I think that it's certainly worth some exploration and perhaps a little bit of introspection for dealers to look at their business and say, just because we've been doing it with this organizational structure for 20 years, does that necessarily mean that I should keep doing it that way? As more and more customers are beginning to do these activities online, and if, going back to my earlier point, just from what we've seen in our initial analysis with the Accelerate program, if I can make more money by getting people out of the way, that seems to me to be something we should take a close look at.
Yeah, talk about the maybe regional differences in some of the tech savviness of the dealers in dealing with digital retailing. Are some of these trends still emerging in some places more than others? It seems like maybe in California or on the coasts, you're going to see a kind of a different level of digital knowledge than say than you're going to see in the Midwest or in the South, or how do you answer questions from different dealers in different regions that may or may not be as tech savvy as some other regions?
Honestly, Phil, I think that you've got progressive tech savvy guys in all regions. I mean, there is I think the number one Buick GMC dealer. It's called Laura Chevrolet. It's down on the southern tip of Illinois, and not a big place, and they sell something like 1,000 new trucks and SUVs a month. That just goes to show you that it doesn't matter where your location is to have thoughtful, effective operators. And so I don't put a whole lot of stock in this notion that some regions are more tech savvy than others. I think that people that are, it's sort of like one of the great things a dealer told me a long time ago is that you always have to be a student of the game. And I think those dealers that are out there that continue to study the game and work on their craft are the ones that are going to, be able to cash the most checks moving forward.
I guess so. I'll ask one more question, and I think we can start winding it down here. And to the audience, we still have a little bit of time. If you have any other questions, we do have a couple more minutes to take an additional question or two. But how often Brian? Do you hear the doomsday scenario where you hear the dealers worry that all these trends are going to just basically put me out of business in the next 10 years? And how do you respond to that when you have a client asking you that kind of a question where they wonder if they're going to even be able to survive with their brick and mortar dealership, given all these trends in digital retailing? Yeah, I hear it all the time on this end, and I'm sure you do too.
Yeah, it's a good question. I do think, Phil, and you and I kind of touched on this a little bit earlier, is that it does seem somewhat problematic for car dealers that have made huge capital investments in beautiful facilities, that increasingly customers are not really looking for reasons to spend 2 to 3 hours there. As one guy told me, if Jeff Bezos ran a car dealership, would he make you sit in his service department and drink still coffee for 2 hours? I don't think Bezos would do that. But I would say the doomsday scenario, I'm not quite there. And the reason why I'm not quite there is that, this year, 2019, we're looking at something like 40 million plus used cars will be sold in the United States. I think Cox Automotive is forecasting 16.8 million new cars. I don't know the total number of cars on the road, but it's something well north of 100 million. I still believe that the auto industry, represents a a pretty decent chunk of the overall gross domestic product of this economy. And I think rumors of the car business demise are greatly exaggerated. So I'm not in that camp that thinks we're going away anytime soon. But I am in the camp that says we do need to rethink the conventional way that we've done things. We need to challenge conventional wisdom. And as I said at the beginning, take proactive measures to try to stay a step ahead of the curve.
I always remind, when I hear the doomsday scenario, I always remind people that the number of miles driven, no matter which kind of vehicle you were talking about, whether it's autonomous or electric or anything else, the number of miles driven is only going to go up. And whether you're car sharing or not, people need to get from point A to point B, and that's never going to change. So you just got to make sure you're still in the game, and if you're not in the game, you can't. You're not going to benefit from it. So that's usually that's usually the answer I give people when I hear that. But anyway, well. That will bring us to the end of this webinar. I want to thank today's audience for their questions, and if you wanted to ask a question that we didn't get a chance to answer, vAuditor will follow up with you by email. If you learned something from this session, please tell your peers about it. The recording will be available in about an hour, and you'll find it at autonews.com/powertraining. When the webinar ends, a survey is going to pop up on your screen. Your feedback helps us get these things better. Thanks again to Brian and vAuto for bringing us this excellent presentation, and to you for joining us. On behalf of everyone at Automotive News, have a great rest of your day.